this. And the first thing I'd say is that, for us, if we're incorporated, we have a lot more options. If we're not incorporated, there are pensions that everybody who is collecting income is going to be involved in. The Canada Pension Plan or the Quebec Pension Plan, if you're in Quebec, that money is going to be deducted from your T4 or T4A income that you're making, and you're going to be making payments into those plans. And if you're self-employed, you're going to make both the employee and the employer sides of those payments into those plans. And people get up think it's a tax sometimes, but it's not a tax, it's a pension. The amount you get out of it is directly proportional to what you put into it, and it's actuarially determined. It's going to be a defined benefit pension plan that's indexed to inflation. It has survivor benefits. It even has some other perks. These are all the things that people, when they are experiencing pension envy, are usually envious about. But for some reason, when it comes to the Canada Pension Plan, because we're all forced to pay into it from our income, we feel differently. But it actually, if you account for the expected returns and the stability of the plan, it's actually a pretty decent investment. The other type of account that everybody gets access to if they have T4 income or even rental income is an RRSP room. And the Registered Retirement Savings Plan is a very pension-like account. It has a lot of the same tax characteristics. So those would be kind of the baselines that most people would have access to. If you're incorporated, you have more options. And this is why it gets confusing for people. I mean, the most common thing people think about when they're incorporated is that you have money that comes into your corporation, you spend some of it, and some of it is kept in there, taxed at that low corporate tax rate. And then later on in retirement, you can take it out as dividends, hopefully at a lower tax rate than your big earning years. So it defers that money, and you can use your corporation as a way of helping to fund your retirement. Now, if you are paying salary along the way, when you're incorporated, so your corporation pays you a salary, that opens up the door to pension and pension-like options. And to be clear, you have to be paying salary to have those options. I mean, you have the CPP and QPP, which aren't optional, but you do get RRSP room, which if you were just using dividends, you wouldn't. And the other thing that paying salary does is those are going to be considered years of service for your corporation with you as the employee. And if you do decide to use something like an independent pension plan later on, having paid yourself salary and hopefully using your RRSP leading up to that puts you in a much better position to benefit from it. And the same thing applies to multi-employer pension plans in that you have to be paying salary from your corporation in order to be able to put payments into a multi-employer pension plan. So the first thing just to talk about quickly, and this is actually relatively simple, is pension taxation. The big thing to know about pensions, whether it's a group pension or multi-employer pension, IPP, RRSP, they're all the same in that they're invested with pre-tax dollars. And people will say, oh, well, if you use a pension plan, then you're playing with corporate pre-tax dollars. Whereas if you use an RRSP, it's personal pre-tax dollars. That's totally irrelevant, because if you're paying the salary out of the corp, there's no corporate tax. And there's going to be personal tax, but there is no personal tax because it's deducted dollar for dollar against your income. So it is pre-tax money, whether it's been purchased by your corporation and purchased by you personally. What is important is the tax sheltered growth along the way as well. So pension plans, whether it's a pension plan or RRSP, the investment income that happens within the plan is not taxed. There's foreign withholding taxes on some investments, but those are generally exempt for most pension type of accounts for most countries. And then the tax is paid eventually. You put that money in there with pre-tax dollars to invest it, but when you get that money later on, you are going to pay tax as income on that withdrawal. So it's tax deferral, and it's 100% tax deferral. And it's also tax-free growth along the way. So you're deferring tax from now into the future, and hopefully in the future, you'll be in a lower tax bracket. Well, I guess you'd be lucky if you're still in a high tax bracket. It means you have a lot of retirement income as well. But for a lot of people, they have higher tax brackets during their working years and less during retirement. And the other benefit is this extra growth along the way where you don't have the drag of taxes slowing down the growth of your money. Okay, so what about registered pension plans for corporations? I'm going to kind of hone in on this aspect of things a bit more. So there's two big groups of pension plans that would be relevant for us as private corporation owners. One would be an independent pension plan, or an IPP, and the other one would be a multi-employer pension plan, or an MEPP. So the example of that one would be this Medicus plan that's come out by MD Financial and Scotiabank. And that, I think that's prompted a lot of the questions about pensions that I've been getting. So what's the difference between an IPP and a MEPP? Well, an IPP is going to be a single corporation. So I have a professional corporation as a physician. I could have an IPP that's for my corporation. And that means that it's going to be invested with my risk tolerance, and the money's going to be there when I need it. And it's going to be managed for me as a single account usually. What happens with an MEPP is multiple corporations basically buy into this plan. And what that does is it pools the management. So you may have some economies of scale, depending what your baseline is. If you're paying high fees at baseline, well, you might get economies of scale by joining an MEPP. If you have low fees at baseline, though, they may be higher. And that's important for you to understand. The other thing that happens with an MEPP is that you're pooling risk. So it's not just about your personal behavioral risk and your personal risks about when you need to get the money. It's a big group of people that are going to be retiring at different times. They're going to die at different times, and it spreads out the risks of having some unlucky outcomes. Spreads it out amongst a larger group of people. Now, for the type of, whether it's a defined benefit or a defined contribution, IPPs can be anything. They can be either, but it's almost always going to be a defined benefit plan, because that's where the advantages kick in for using an IPP with a corporation. If it was just defined contribution, you might as well just use an RRSP. But there are benefits, there are advantages when it's a defined benefit structure. So the MEPP, the main one I'm going to talk about is this Medicus plan. It's defined benefit as well, and that you're going to have a benefit paid out. But that benefit does have some variability to it, in that if the investments within the MEPP are doing better than expected, then you may get an adjustment for inflation to increase some of the benefit. And if the investments are doing worse than expected, then you may have the benefits reduced. So that the implications of that are different for an IPP and an MEPP. And it gets tracked along the way to make those kinds of decisions. And what happens is you have to have an actuarial done every 3 years. And what that does is it's going to assess how much money is in the pension plan, how much do they owe out as benefits, and is it enough to make that sustainable? And if it's more than enough to be sustainable, then it's overfunded. And if it's not enough to be sustainable, it's underfunded. And the implications are different for an IPP and an MEPP. So if an IPP, or the independent pension plan, is overfunded, then your corporation would have to take a contribution holiday. So if you have too much money in the corporation's IPP for the benefits to be paid out, you can't put more money in there. If it's underfunded, then you can put extra corporate money in there. And the reason why I made this yellow is because it could be good or bad. Generally, it's actually good for the IPP and a corporation to be coming out underfunded, because it means you get to shift even more money from your corporation, which is tax exposed, into this tax sheltered pension account. And by shifting that, it also reduces the problems that you might have with the passive income limits or trapping of refundable dividend taxes. It helps to decompress the corporation more, which is one of the biggest advantages of using an IPP. Now, if your IPP is underfunded because your investments are performing, are having a low return because they're bad investments, well, that's not a good thing. So you don't want it being underperforming because of bad investments. You want to have investments that are performing as expected, but they tend to be lower returning investments like bonds or fixed income, those parts of your portfolio. Now, the other way that this works is different with an MEPP. So if the multi-employer pension plan is overfunded, you might have a benefit increase. If it's underfunded, you might have a benefit decrease. So it's a bit of a different situation. The amount that you're putting into it stays the same. So with an IPP, it's going to be T4 income to be pensionable. If you have prior years of service when you're opening that, then you can count that in. There's an annual contribution that's going to be based on the actuarial assessment. And if you're doing a defined benefit IPP, which is what most people would do, the actuarials are going to change as you get older. So an RRSP contribution, the maximum amount you're going to be able to put in is pretty constant. It's the orange line here. When I did this little chart, it was just under 30,000. It's more than that now. And an IPP is going to go up over time because the closer you are to retirement, the more you have to be able to put in there to be able to meet that benefit obligation that's going to be there. So this is an analysis with a typical $200,000 a year salary. And you can see somewhere around the age of 37, you can start to put more contribution each year into an IPP than an RRSP. But because you're also paying the actuarial cost to get that assessment, it's not really an advantage to using an IPP. When you account for that, the advantage of an IPP comes in sometimes after the age of 40. And you can see the amount you could put in each year after the age of 40, it becomes progressively more and more and more for an IPP than it would for an RRSP. So you're able to shift more money from your tax exposed account, like your corporation, into a tax sheltered account. That's one of the big advantages of an IPP. And that's why you'll hear people say that an IPP is something you might consider after the age of 40. And that's because that's when this actuarial allows you to contribute more. Just to kind of tie it back up with a summary. So RRSP during the IPP or an MEPP during the contribution phase, they're all going to be 100% tax deferral, whether it comes from the corporation or it comes to you personally, it doesn't really matter. It's 100% tax deferral. With an RRSP, it's going to be 18% of your income up to a maximum. Same thing with the MEPP. With the IPP, after the age of 40, you start to be able to allow to make larger contributions. And that's where an IPP starts to have an advantage. When you're managing that, if you're doing an RRSP, you might be able to do that DIY, which is going to save you a lot in costs, but it is going to be governed by your risk tolerance and your ability to do the plan. With an IPP, you're probably going to be using an advisor, which again, your risk tolerance does come into play, but it's with coaching. And that's one of the big value adds that an advisor should have is helping to coach you to manage your risk tolerance and weather those storms when things happen in the markets. And with an MEP, there's a pension manager, you can't mess with it. So there's not really much behavioral risk there on your part. Another difference is that with sequence risk that I just mentioned, if you're individually investing, it's you. If it's a multi-employer pension plan, it's mitigated by the group. In terms of benefits, with an RRSP, you have more control because you can control the amount that comes out. With pension plans, there's a defined benefit. That's what comes out. You don't really control that. And there are regulations around how much is allowed to be paid. If you want to leave the pension plan with an RRSP, there is no leaving it. It's your money already. If it's an IPP, it's fully commutable. So everything that the value of that pension plan is fully going to be paid out to the owners of the corporation. If it's an MEPP, you're part of a group of companies and you only own your little piece of it, and they have to value that piece and then pay that out like if you were leaving an employer with a pension. And there are rules about how they value it, but they value it from the lens of they give you that money and they have to keep the pension plan sustainable. So they are able to reduce the payment to maintain the stability of the pension plan or delay it. What happens when you die is also important. If it's an RRSP, it's pretty straightforward for you to manage it. If it's an IPP, it's going to be potentially part of your corporation or a beneficiary. You need to make sure you have the estate planning set up. But again, the money still flows through to you or it flows through to your beneficiaries or things that you choose. With a multi-employer pension plan, when you die, the money stays in the pension plan and helps the other people that are surviving. So if you're in a multi-employer pension plan and you live a long time, that's a benefit. If you don't live as long and your spouse doesn't live as long, it's not as much a benefit. I mean, there are spousal benefits that go with it too. So I'm talking about on the second death. So when would I consider these? So IPP or PPP, I might consider that if I'm over the age of 40, I've used salary, I've got a corporation that's got a passive income problem, so I could help save some of that problem by using another tax shelter or a larger tax shelter. I have a large allocation to something that's going to have lower expected returns as part of my portfolio, like bonds, for example, because that allows me to put even more money into that pension plan, which is where it gets its advantage. If it's an all equity portfolio with a high rate of return, it may actually not perform as well as you may not be able to put as much in as you would with an RRSP potentially each year. And I'd also have to consider whether the costs and complexity of going to that type of IPP structure is worth it compared to what I'm doing now. So that depends what I'm doing with my RRSP. For the MEPP one, when I consider that, again, you have to be using salary. And I'd be using, if I'm using a full service costly advisor and investing model, I think then in that, if it's a lot of fees you're paying now, there could be efficiencies to having the bundled management of the MEPP. But if you have reasonable advisor and investing fees, maybe not so much. I'd also, it's useful. I don't want anything to do with managing my investments at all. I want a relatively guaranteed and stable income stream. I mean, it's not guaranteed. There could be variability there, but when they manage these pensions, they're usually pretty conservative about meeting their liabilities. If I have a hard time selling investments to spend money, or if I have a hard time paying tax to spend money, and that's a behavioral issue that I think is actually important with pensions and when you're thinking about your retirement planning. A lot of people have a hard time spending money, selling stuff. They just want to live off their dividends of their investments, or they have a hard time taking money out of their RRSP or their pension and paying tax on it because they don't want to pay taxes, and they end up not having money that they're spending now, and they have this big estate when they die. Now, with those advantages, I think if you're really if you're willing to accept some of the extra risks that go with individual investing and some of those behavioral issues, then you are going to leave some money on the table by having an MEPP.